So everyone, welcome back. It's Ben Morales, your personal financial coach. In today's video, we are going to break down a amortized loan. So if you purchased a home in the last couple of years, this video is going to be right up your alley because you may be thinking, why does my mortgage not go down? Why does the balance stay as high as it does? Well, this is the reason why. I'm going to show you why, how a amortized loan is structured, and why it seems like you're not making any progress. This particular example that we're going to be using today is a loan that's at $300,000. That loan amount and the interest rate that is being calculated for that amortized loan is at 6%, and it's going to be over a period of 30 years. So it's a basic, typical type of loan. If you go to a bank, this is probably what you're going to be offered. If you either bought a home or you're getting ready to buy a home, look out for this because that's exactly what they're going to offer you, more or less. Now, the interest rates might be different, but the principal of amortization is the same. So when you get an amortized loan or a mortgage, there's two components to it. Okay, there is your payment, and that payment is basically broken down into those two components, which is your principal and your interest. Now, when you begin the process, because you just recently got the loan, so in this case, it's a recent $300,000 loan, you present more of a risk to the particular lender. And the lender, you being a new homeowner, they really don't know how well you're going to do at that job. Yes, you got qualified. Yes, they look at your credit. Yes, they look at your income. They did the due diligence to make sure that you are a good borrower and you're not going to burn them. But that doesn't mean you're not going to pay the price for it, because you definitely are, especially in the beginning years. So this is what a loan amortized at 30 years at 300,000 and at a 6% is going to look like. When you run the calculations, you can do this yourself. You can go to calculator.net, or you can use Carl's Mortgage Calculator. Both of those are on the internet, and put in your numbers, whatever your loan is. But in this particular case, when we put in these numbers, the dollar amount of a payment that we're going to get back is $1,798.65. So remember, this has two components to it, right? That is your payment, but there's something that's happening in the back, and it's how the interest is being calculated and where that payment is being applied. So you'll see, if you go to the paperwork where you did your loan, you're going to have a big stack of papers. In there, you're going to find an amortization schedule. That is the schedule of your payments for you for the next 20 or 30 years. And we can see just in this example, this amortization schedule begins at $300,000. So let's figure out how the bank is calculating what is going to be your interest rate on this $300,000. It's a simple calculation for that. You can do it yourself for your loan. But basically, you take the loan amount, right, what was financed, and you multiply that by whatever your interest rate is. In this case, it's 0.06. You take that number and you divide it by 12, and that's going to tell you that month's interest. Okay, so from the calculation of the payment, $1,798, the interest portion of that payment is $1,500. So we can see $1,500 going toward interest. $298.65 is actually what's going toward the principal. So what do? We take the $298.65, we deduct it from the $300, we're going to get a new balance now, which means that was the month of August. The month of September, you're going to start with that new balance, which is going to be $299,701.35. So this is how that mortgage, the calculation of that interest is calculated with a particular mortgage. Because it's done on a monthly basis, whatever you start that month at, that's what you're going to be getting charged in terms of a interest rate, or the cost of the loan is what it's going to be charged against you. So $299.701.35 is basically the upfront charge that this person is going to pay, because that month closed. The month of August closed. That's the balance that kicked in, right? $299,701. So that means in September, because that's the balance, we go through the calculation once again. 300,000, or in this case, it's going to be that new balance times 0.06%, and you're going to divide that by 12. The new number now is, in terms of interest, $1,498.51. So that is the new interest cost for that particular month. And you can see here that the interest rate, or the principal that was paid down, is only $300. So we can see, if we follow the course of time, and I only did this over a period of 10 months. I ran out of board, obviously, so I wasn't going to be able to show any more length of time, but the principal doesn't change. You can see that for first, and particularly the first maybe 12 to 15 years, the majority of the payments that you make to the mortgage is going to impact the interest more so than it is going to impact your principal. And this is why, this is your case, you'll probably never pay off that mortgage. You will probably refinance this mortgage at one point in time, because especially where the market is going, if it holds true with everything that's happening and the interest rates do start to come down, you're going to start getting marketing letters and invitations to go back into the bank and, hey, we're going to take your 6.5 rate, we're going to drop it to a 6, and you're going to start making a new payment, $150, $200 less. You can definitely do that, but the trap is when you start to do that, you will begin this cycle all over again. So don't do that to yourself. Don't trap your money long term again in this particular cycle. Do something different. Start to implement the rapid payoff method so you can more quickly and efficiently get yourself out of debt, and then start using your cash flow to build wealth. That's the name of the game. We can see as this time progresses, at their 10-month period, the only the portion that has been paid off toward the principal after 10 months is $3,054.60. The portion of the $17,986.50 that has been impacting the interest is $14,931.91. So I want you to let that sink in. From $17,000, almost $18,000 in payments, $14,900 is going toward interest. And again, this is just 1 year. This is going to repeat itself, especially in the first 7 years, which is heavily front loaded. And this is why you will more likely than not never pay off this mortgage. And you will eventually get yourself into another mortgage before this one is over and start the process all over again. And guess what? The banks know this. They know this very well. Now, you could definitely do what a lot of proponents say, why don't I just take the extra $200 in cash flow and send that into an extra mortgage payment? You could actually do that. I actually calculated that if you send the extra $200 a month to the particular principal, that will definitely impact it. Okay, you would have then made a total of $5,120 in payments, extra principal payments, and the loan amount, the balance would have gone down to $294,898.78. But again, folks, there is a better way. It's quicker, it's more efficient. In the next video follow-up to this, I'm actually going to show you, by chunking those payments and implementing the rapid payoff method, what that's going to look like in terms of how it impacts this particular loan. So you don't have to only deal with a mortgage loan. There's another way to do this, and stay tuned for that video. So I want to thank you for supporting the channel. Please continue to like, subscribe, and share, and make comments into the section. I actually got this idea from a viewer, so I want to say thank you to Miss M for putting this down as a suggestion, and I hope this makes a lot of sense to you, Miss M. Looking forward to your feedback on that. So on to the next video. I do thank you for tuning in. Take care and God bless.